In February 2026, the world's most valuable company, Nvidia, had a problem. It had just promised to invest up to $100 billion into OpenAI. OpenAI would then take that money and use it to buy chips from Nvidia. In other words, Nvidia was funding its own revenue. On paper, it looked like the greatest flywheel in corporate history. In practice, it was one of the clearest warning signs in a generation that something had gone very, very wrong. Because when news broke a few weeks later that the deal had quietly stalled and was, in Jensen Huang's own words, never a commitment, the entire market convulsed. Oracle's stock, which had spiked 36% in a single day when it announced a $300 billion cloud deal with OpenAI, collapsed. Microsoft got punished for disclosing that nearly $250 billion of its commercial backlog was tied to a single customer, OpenAI. The AI industry had spent 3 years telling the world that demand was infinite, the technology was inevitable, and the returns would justify anything. And then, in 48 hours, everyone remembered the numbers didn't actually add up. This is the story of how the most hyped technology of the 21st century quietly began eating itself. And it's not just a story about a bubble, it's a story about what happens when an industry confuses spending with progress and valuation with value. How we got here. To understand why AI is in trouble, you have to understand what AI was supposed to do. When ChatGPT launched in late 2022, the pitch was simple and, for a moment, genuinely electrifying. These new models could write, code, reason, and summarize at a level that felt like science fiction. Investors looked at the technology and drew a straight line into the future. If a chatbot could already draft a decent email, then in 5 years, it would run entire companies. Every knowledge worker's job was in play. Every enterprise would need to restructure around AI. Every industry would be rebuilt from the ground up. And so, the money came. Not millions, not billions, trillions. By early 2026, OpenAI alone had committed to roughly $1.4 trillion in spending on compute, power, and infrastructure, against annualized revenue of just over $20 billion. Microsoft, Amazon, Google, and Meta's combined AI capex was projected to hit $670 billion in a single year. JP Morgan estimated $5 trillion would be spent on AI infrastructure by 2030. To put that in context, when measured as a percentage of US GDP, it's more than the Apollo program, the interstate highway system, and the railroads combined. The only capital project in American history that even comes close is the Louisiana Purchase. So here's the obvious question. If the entire economy is being bet on this technology, the returns must be there, right? Actually, no. The gap nobody talks about. In August 2025, MIT's NANDA initiative published a report titled The Gen AI Divide: State of AI in Business 2025. It examined 300 public AI deployments, interviewed dozens of executives, and surveyed hundreds more. The conclusion was devastating. Despite $30 to $40 billion in enterprise spending on generative AI, 95% of organizations had seen zero measurable return on their investment. Not modest returns. Not returns still emerging. Zero. As in nothing. The reasons, according to MIT, weren't mysterious. Most AI tools didn't actually learn from a company's workflow. They produced generic outputs that needed constant human correction. Employees preferred their own personal ChatGPT accounts over the expensive enterprise tools their bosses had bought. In one case cited by the report, a law firm spent $50,000 on a specialized contract analysis tool, only for its lawyers to keep using the consumer version of ChatGPT because the paid product was too rigid. Then came the horror stories. Deloitte had to partially refund the Australian government after an AI-generated report was found to contain fabricated citations and references to academic papers that didn't exist. Law firms around the world started getting sanctioned for submitting briefs with hallucinated case law. By April 2026, a public database tracking AI hallucinations in legal filings alone had logged 1,317 cases. Accenture's $75 million contract with the U.S. Patent and Trademark Office to embed AI into patent examination ended with the office banning generative AI outright because the system kept inventing prior patents that didn't exist. And yet, the investment kept accelerating. Why? The machine that funded itself. Because at some point, AI stopped being about products and started being about financial engineering. Consider the mechanics. Nvidia invests tens of billions in OpenAI. OpenAI uses that money to sign a $300 billion cloud contract with Oracle. Oracle, to fulfill that contract, spends roughly $40 billion buying 400,000 Nvidia chips. Nvidia reports record revenue. Its stock hits a $5 trillion market cap. That paper wealth is then used to justify more investments into more AI startups, which all circle back to buying more Nvidia chips. The dollars were, quite literally, the same dollars, just rotating. Economists and analysts started calling this circular financing. Ray Dalio compared it to the dot-com bubble. Jamie Dimon admitted that a lot of the money being invested would eventually be lost. Even Sam Altman, running OpenAI, conceded in 2025 that yes, there was almost certainly a bubble.
The problem with circular financing is that it works beautifully right up until a single link in the chain slows down, and that's exactly what started happening. Bain & Company estimated that AI companies would need $2 trillion in annual revenue by 2030 to justify the infrastructure being built. Current projections suggested they'd fall short by about $800 billion. A National Bureau of Economic Research study found that despite executives projecting AI would boost productivity by 1.4%, 90% of firms actually reported no measurable impact on workplace output at all. None of this was a secret. JP Morgan analysts had flagged it. The Federal Reserve had flagged it. Memory chip manufacturers like Samsung, SK Hynix, and Micron, companies that would benefit most from the boom continuing, were quietly refusing to expand capacity because they didn't believe the demand projections. These are firms that have lived through every semiconductor cycle of the last 40 years. When they tell you the music is about to stop, it's probably about to stop. The moment the story cracked. What makes 2026 different from every previous AI skepticism news cycle is that the cracks are no longer theoretical. They're showing up in the numbers that even the true believers can't ignore. Microsoft disclosed $35 billion in AI infrastructure spend in a single quarter. Its share price fell 4% in after-hours trading anyway, because investors started asking a simple question: where exactly is the return? Oracle's stock dropped 50% from its high, erasing roughly $450 billion in market value, as analysts looked at its 6 times debt-to-equity ratio and realized the company had essentially leveraged its entire balance sheet on OpenAI's ability to pay. Combined free cash flow at Amazon, Google, Meta, and Microsoft was projected to shrink by 43% between late 2024 and early 2026. These are not companies in distress. These are the strongest businesses on Earth, being slowly bled by capex commitments they can't back out of. And then there's the human cost, which nobody wants to talk about but increasingly can't avoid. OpenAI's own data reveals that more than 1.2 million users per week express suicidal intent while chatting with ChatGPT. By early 2026, at least 11 personal injury and wrongful death lawsuits had been filed against AI companies, including one against OpenAI itself after a college student suffered a psychotic episode following prolonged chatbot use. The same companies telling investors that AGI is around the corner are also quietly defending themselves in court for products that can't reliably handle a conversation with a distressed teenager. Why this is bigger than AI? The interesting thing about the AI collapse, if that's what we're watching, is that it isn't really about AI. The technology is genuinely useful. Large language models actually do save time. Real companies are getting real value from them. Maersk saves over $300 million a year using AI to predict port congestion. Startups built by 20-year-olds have gone from $0 to $20 million in revenue in a year by targeting one specific problem and solving it well. The collapse isn't about whether AI works. It's about whether $5 trillion worth of it works. And that's the principle that runs through every bubble in history. A technology can be transformative and still be catastrophically overvalued. Railroads were transformative. Most railroad investors lost everything. The internet was transformative. The dot-com crash wiped out $6 trillion in equity value anyway. The question was never whether the thing would matter. It was whether the capital being poured in was proportional to the actual economic return it could produce in the time frame investors expected. What makes AI particularly fragile is that, unlike previous bubbles, the investment isn't distributed. 5 companies now hold up 30% of the S&P 500. The Magnificent Seven make up 35% of the entire index, the same concentration as at the dot-com peak. A Harvard economist estimated that AI infrastructure investment accounted for 92% of US GDP growth in the first half of 2025. Not the use of AI, the building of AI, which means if the building stops, if even one major player decides the returns aren't there, the entire American economy takes the hit. And here's the part nobody at an AI conference wants to say out loud. The building boom was always going to stop. Not because the technology failed, but because the math never worked. You cannot spend $1.4 trillion against $20 billion in revenue and pretend it's sustainable. You cannot have 95% of enterprise pilots fail and keep telling boards that this is the year of transformation. Eventually, somebody looks at the spreadsheet and asks what the rest of us have been asking for a while now. Where is the money actually coming from? And who exactly is going to pay it back? The answer, as it turns out, is the same answer every bubble gives right before it ends. Someone else. Someone later, not us. Until one day it is.